So, when I talk about the construct for the businesses that is required or that is pertinent to generate wealth, I think the first thing that is very important is to look at the track record. So when we talk about the track record, it's all about looking at the historical numbers. And of course, when we talk about financial investing, it's also always about profit and loss, balance sheet, cash flows, because numbers speak a lot. Numbers tell us what has gone through in the last few years. How did the company manage itself during the good times, during the bad times? All of that comes, in front of us. Now, what I have done here is I have mentioned in the order that we like to see, how these numbers we look at. So, for example, when I'm looking at P&L, now P&L is actually just one particular period. It could be for 1 year, it could be for say 1 quarter, or say for half a year, but that's where it ends. When we look at balance sheet, it's a cumulative of last many years. And every business goes through a good and a bad cycle. How did that business manage itself during a bad cycle will actually get reflected in a balance sheet. But even with balance sheet, as somebody rightly said, what it reveals is interesting, but what it conceals is much more exciting, right? So even in balance sheet, there can be a few hidden things. So for us, the most important thing is actually cash flows, because we strongly believe that cash flows do not lie. It's very, very difficult to manipulate cash flows. And if you look at in a block of 3, 4, 5 years cumulative cash flows, it's even more difficult to manipulate those cash flows. Of course, I agree that there will be certain exceptions, but they are truly, truly outliers. In my so many years of experience, at least in the Indian context, there are, you can count on your fingertips how many companies can have done something wrong on the cash flow side. So this is something that we never miss. Cash flows is something that we are very, very cognizant about, and we pay a lot of attention to it. So in that sense, track record is very, very important for us. The second important thing is the business scalability. Now, this is where it's very, very essential to understand your landscape. Because, actually, if you think about it, India is a very large country with such a large population. For everything, there is going to be a large opportunity. But within those segments, how large can it be for you? Or can you actually even increase your landscape? Like, for example, if you look at, say, the pharma industry. Now, the domestic formulation industry is about rupees 1.5 lakh crores, so it's about $20 billion. Now, if we think that can the Indian pharma industry also cater to the world markets? So if you just take the generics market, it just multiplies the entire opportunity, right? And in fact, actually today, if you see the construct of the Indian pharma industry, $20 billion of revenue does come from the domestic formulations, but another $20 billion, which is equal size, comes from the generics market, the global generics market, which makes it $40 billion. And if I include some of the other businesses like the CDMOs and the CRAMs, that will be probably another $5 to $10 billion. So it's about almost $50 billion, which is only a $20 billion size. So because the growth of the whole idea about growth will be dependent on the kind of the opportunity which is there, right? The other thing also very important is in terms of understanding the scalability is the industry structure, right? How fragmented the industry. The more the fragmented, a little more difficult it is. But there are certain industries which are very, very consolidated already. For example, if you look at the auto industry, now every segment within the auto industry, it could be passenger vehicles, it could be two-wheelers, it could be commercial vehicles. The top 2 players or maximum the top 3 players will actually have about 70-80% market share. So it's much more easier for us to decide on how do we invest in those businesses, because where are they headed? It's much easier. Like for example, telecom industry, for last so many years now, we've seen the consolidation phase happening. And now it's almost boiled down to 3 players and probably 2 players over a period of next 1 or 2 years. So, it's much easier then to make an investment call over there. The third, which is the inherent profitability, which is about the ROCE and ROE percentages. Now, all of us know that return on capital employed and return on equity as a percentage is very important and critical, because how much did I invest and how much did I earn is something what we all like to know, and we all like to have it higher and higher. But I think it's much more than that. The way I look at it is that this is actually the fuel for growth. We all talk about growth, growth, and growth, but to capitalize that growth, the opportunity size is very large, industry structure is good, but how does one capitalize on that growth? Because every company will have to actually reinvest a lot of money in the business to take it to the next level. Now, for that to happen, you need to have your own internal accruals, and that's only possible if you have higher profits, higher ROCs, because that is truly your fuel for the next level of growth. So to my mind, this ROC and ROE are actually they play a very big catalyst role in creating a very strong base for the next few years of growth. Now, the management quality. Now, how much ever I emphasize on this, I think it's going to be less. Because if one looks at most of the companies that have created wealth in the last few years, I think the entire credit goes to management quality, because there is opportunity size, there is a decent industry structure, but only a few of them are able to capitalize on it. So many times we come across where managements are honest, but we don't find them capable. If they're capable, we don't find them honest. If they're honest and capable, they don't have the larger vision picture. They always miss the bigger picture. So that's where your integrity, which is the honesty, comes into play, which is the strategy. Having a bigger picture in front of you, or able to see and having the vision is very important. And flawless execution, I think that's very, very critical. Executing to the T is something so important. Because we have seen so many managements where they are very honest, they have a good thought process, but they falter on the execution side. And as you would have seen in my picture here, I very deliberately put it in a pyramid format, where I'm really saying that what is the importance of each of these parameters. And I think management quality comes at the top of it. But when it comes to equity investing, see, these 4 parameters are about how does the business generate wealth, how does the business create, how does the business go to the next level, how does it create its own scale, its own size, its higher profits, right? But when it comes to equity investing, I think there is one more very important point, and that is the purchase price discipline. At what price do I invest in that stock? Because it's all this is all great, but if I have bought it at a wrong price, of course, first is you can't buy companies which do not tick the first 4, and then it's very important to have the right purchase price. And let me tell you one thing: in my so many years of experience, there is, investing is actually about science and art. And this valuation, which is the purchase price, is a lot to do with art. For example, if I look at number 1, number 2, number 3, a lot of it is science. We all have a lot of data. We can put it in a very structured format, and we can decide this is eligible, this is not eligible. We can do all of that. I think management quality is a combination. Evaluating management quality is a combination of art and science. But when it comes to valuation, a large part of it is art. Let me give you a small example of it. In the year 2000, Infosys did a profit of about 300 crores. And in the year 2014, that company's profit grew to rupees 10,000 crores, which is 30x in 14 years, which effectively means more than 25% compounded, actually almost 27% compounded growth rate over 14 years. Now, if you think about Infosys is the best company, and at that point in time, TCS wasn't listed, so Infosys was the number 1 company, the biggest IT company in that sense. It had the opportunity size was the same for all the other IT companies also. But barring the top 2, 3, or 4 companies, most of them were not able to scale up the way Infosys or a couple of them have been able to do it, right? So, it was the best company. They had the right opportunity size. Their ROCs at that point in time were very high, almost 40-50%. In terms of integrity, and I think integrity is not only to wealth, to the shareholders, but integrity towards your clients, integrity towards your employees, integrity towards your partners, integrity with your shareholders. All the stakes were there. Strategy-wise, they never missed the bigger picture. and flawless execution. Because unless these three would have fallen in place, for Infosys to grow from 300 crores of profit to rupees 10,000 crores, today there are probably less than 10 companies. In 2014, there were less than 5 companies which made a profit of more than 10,000 crores in the Indian context. Today also, I think there will be less than 10 companies. So unless all of that would have fallen in place in a big way, I don't think Infosys would have reached that level. So all the ticks are absolutely in there. But let me tell you an interesting point there. An investor who invested money in Infosys thinking that it will grow to 10,000 crores of profit in 2014, and obviously if you're growing at 25-27% compounded rate in terms of profit, you definitely expect that you should make that kind of money. But the investor who invested money in 2000 probably made in 2014 mid-single digit return, maybe 6-7%, which is probably similar or even below than the bank fixed deposit rate that was prevailing at that point in time, right? So the only problem was that you bought it at a wrong valuation, in spite of you getting it all right. And this is Infosys. Had you bought any other IT stock in those heydays, even today after 20 years, you would have lost 60, 70, 80% of the money. So buying the right purchase price, I think it's a very, very important element when it comes to equity investing. So this is all very, very pertinent. There is no doubt about it. And I would say that this construct has to be always in your background when we are trying to look at investment trends. But is it enough? That's the question. That's the real question, right? So from that perspective, what I would like to say is that every business goes through a good and a bad cycle. The question is, where we invest our money, does it have those business have tailwinds? We need to really catch those tailwinds where the businesses are able to grow a little faster than the GDP growth. They have certain catalysts which are going to come into the play, and that is where I talk about swim with the current, right? And this construct for the businesses that generate wealth will be my principles, where I would not like to compromise on them. Now, finding investment trends and then finding companies within those investment trends along with this business construct is something which is how we work out here.